On today's hot sheet, I'm discussing three of the nation's largest trade associations' letter to the Fed, plus Fannie Mae's home purchase sentiment index. Today is Tuesday, October 10th, 2023. I am Byron Lazine, and the hot sheet starts now. Welcome into the hot sheet. If you're here with me live, let me know in the live chat which market you're tuning in from. Get the most out of our content at BAM by becoming a member of BAMX. Use code HOT with the link down below to get 10% off of BAMX. You get all of our daily downloads from this show, all of our content, and the after party today. Today we're doing the webinar with Tom Toole, myself and Tom Toole on business planning, 3 p.m. Eastern. That link is also down below, but you get access to the after party with all BAMX members. That'll be today, starting at 3 p.m. after party to follow. Use code HOT to get 10% off of BAMX. All right, there was a letter written by the three largest trade associations, the largest in the nation, of course, being National Association of Realtors, and that letter was directed to the Honorable Jerome Powell, the chair of the FOMC, Board of Governors, Federal Reserve System, addressed to 20th Street and Constitution Avenue Northwest, Washington, D.C. RE providing market certainty on rate path MBS sales. MBS sales would be mortgage-backed security sales. And here's the letter. We'll go through some of the highlights here. Dear Jerome Powell, the MBA, Mortgage Banker Association, the NAR, National Association of Realtors, surprised they had time to engage in this letter, and National Association of Home Builders, NAHB, write today to the Board of Governors of the Federal Reserve System to convey profound concern shared among our collective memberships that ongoing market uncertainty about the Fed's rate path is contributing to recent interest hikes and volatility, interest rate hikes and volatility. Interesting to note here that NAHB, National Association of Home Builders, said, hey, we're in alignment with MBA, Mortgage Banker Associations. We're in alignment with NAR, the National Association of Realtors, because who's benefited the most out of the three groups when it comes to this rise in interest rates, in specifically the 30-year fixed rate? It's been the NAHB members. It's been home builders who have benefited the most because they've been able to buy rates down. The national home builders have been able to do this. Your small mom and pop builder wouldn't be able to float a mortgage unless they were holding paper. Totally different story. Certainly a rare situation. But the national home builders that are building the majority of the homes, they've been able to use their mortgage company to lend money to home buyers, of course, and they've been able to do it at a lower rate than the market rate. They also have controlled inventory in one of the lowest inventory levels we've ever seen, certainly the lowest in the last 13 months on new listings ever recorded. So they've been in this unique power position with the housing starts that they have. Okay, so they go on to say, according to MBA's latest weekly survey, mortgage rates have now reached a 23-year high. We're talking about that, the high since December of 2000, which has dragged application activity down to a low last seen in 1996. So the mortgage demand, the mortgage activity low is now hot, lowest since 1996. That's a 27-year, 28-year, I've even seen in some cases, low. The speed and magnitude of these rate increases and resulting dislocation in our industry is painful and unprecedented in the absence of larger economic turmoil. This letter to Jerome Powell is significant because these three trade associations, NAR, MBA, NAHB, they're tapping out. They're saying, hey, no more, no mas, no more, Jerome. You can't do it anymore to us. We can't see a future forward for housing if you continue to jack up the rates. It's essentially what they're saying here. Today, the spread between the 30-year rates and the 10-year treasury yield is at historically high levels. Okay. This we've talked about. We did a Knowledge Brokers podcast with George Ratu, chief economist at KCM, on this topic. We've talked about it here. We've covered it in past hot sheets. The spread between the 30-year and 10-year is historically high. It's larger than normal or average run on that spread. One of the reasons it stayed high is the crisis that we had earlier in the year with regional banks, with Silicon Valley Bank and others, two of the three largest bank failures ever in the U.S. It's one of the reasons they point towards for this spread to be higher than normal. It's up over 3. It can be, on average 2 or lower than 2. So if the spread basically, and they actually break this down for Jerome, the difference between the current spread and the long run average, where this spread between the 10-year and the 30-year typically is, indicates rates for homebuyers across the country, they're at least 120 basis points higher than they otherwise would be. So that spread is operating right now 120 basis points higher than normal. So in layman terms, Jerome, the uncertainty-induced mortgage to treasury spread is costing homebuyers an extra $245 in monthly payment on a standard $300,000 mortgage. $600,000 mortgage, you could just double that up to be $500. Further rate increases and a persistently wide spread pose broader risks to economic growth, heightening the likelihood and magnitude of a recession. So in this letter from NAHB, MBA, NAR to Jerome Powell yesterday, they are saying, hey, because of where we're at on the spread between the 10-year and the 30-year, we are heightening a likelihood of recession here in 2024. They're using the big R word to threaten Jerome, to make sure Jerome Powell understands, hey, we got to do something here. You got to stop raising the rates or we're absolutely going to go into a recession. Now, there's an argument on maybe I know Jerome, ideal case, he pulls off a soft landing. We bring inflation down. He's seen as a Fed chair god for ages to come. But another scenario, another out for Jerome is a short recession, a very small recession that actually brings inflation down. And then he's the savior that comes in and brings us out of recession by cutting rates. That's another scenario that Jerome could play. Because, of course, remember, Jerome Powell is obviously worried about 2% inflation, but that the sub note there, A1, would be his legacy. Jerome does care about that as well. Furthermore, a leading source of inflation in recent months has been increases in shelter costs. In the August CPI report, consumers were up 3.7%, while shelter costs were up 7.3%. In July, shelter inflation was responsible for 90% of the gain for consumer prices. The most effective approach to tame shelter costs and assist on the broader inflation fight is to facilitate the construction of attainable, affordable housing. Well, yes, MBA, yes, NAHB, yes, NAR, but you guys should have been doing something about that years ago. We're paying the price right now for everybody's lack of building affordable housing. Jerome can't fix that, okay? He can't fix the facilitation of construction of attainable, affordable housing, okay? The most effective approach to tame shelter costs is what this letter is saying to Jerome, is to facilitate construction of attainable, affordable housing. He has very little to do with that. Go talk to, you guys all have headquarters or an office in Washington, D.C. So go, to Congress and talk to them. Go talk to some of the local state leaders where have all these restrictions on building. If you lift some of those restrictions on builders and developers, you'll see deals being made on more affordable housing. They go on to say here about the affordable housing part, sustained wide spreads or further increase in interest rates make this economic goal more challenging, by limiting lot development and home construction, exacerbating home supply and pricing out millions of households from the goal of home ownership. Well, you're saying two different things there. You're saying two different things in this letter. There's no question millions of households are now priced out of the goal of home ownership. That does have to do with what Jerome Powell and the Fed are doing. It also, the first problem is the lack of supply. But right now, just home buyers that were looking a year and a half ago and they're looking today, some have just been naturally priced out of the market with the higher interest rates. It's absolutely a real thing. And it's not the buyer pool is smaller. We saw that with the mortgage demand being the lowest in 27, 28 years. That's absolutely true. But that doesn't fix the problem with housing supply. Jerome can't fix whether you have low interest rates or high interest rates, how expensive it is for a developer and how long it takes for a developer to get a project off the ground. You start to shorten that time of, before you can even start building, 2 or 3 years to put the project together. And then all of the costs that are associated with that, you get rid of some of that or give some tax incentives to some of these builders with a trade-off for affordable housing, then naturally you'll see more affordable housing get built. But they don't do that. They make deals for more apartments and then spin that off as affordable housing. Are apartments right now more affordable than buying single family? Absolutely. I mean, the spread on that is significant right now as we sit here in October of 23. But government officials want to jam down everyone's throat that is considered affordable housing. It's also pushing more people out of the dream of home ownership. Yesterday, we reacted to, here on the hot sheet, you can go back and listen to it. We reacted to the Fox Business clips recently with Glenn Kelman over the weekend from Redfin, of course, CEO of Redfin. And, he makes the case that the dream of home ownership is not attainable, and the belief of home ownership is dissipating for many of America's young professionals. And so when you give up that belief, like we talked about yesterday, you start to give up on savings. What are you saving for? And that's where we're seeing savings become depleted right now. When that belief isn't there that home ownership is a possibility because there's no inventory coming online that meets the price point that you can afford. And then, of course, when we have sustained interest rates higher for longer, the buyer pool just continues to shrink. This is why, as real estate professionals, as agents, I encourage you to think really long term as opposed to short-sighted in your approach to your business. Short-sighted would be, I'm just going to work with the people that are ready to buy now. You should spend most of your time in the car doing deals with those that are ready to buy now because they need to be served right now. But those that are going to be thinking long term are going to be helping a lot of people understand how to get in position for home ownership. They're also going to be going much wider into 2024 because as the buyer pool shrinks, you'll have to solve more problems to find those transactions. Those agents that are thinking long term in this market, as things do adjust, as things do shift in the future, are going to be set up for massive success. So to sum this letter up from NBA, NAHB, and NAR, page 2 of 2, we strongly urge the Fed to make 2 clear statements to the market. So, of course, the Fed is meeting on October 31st and November 1st, and we'll get their latest move the afternoon of November 1st. And so this recommendation is certainly pointing towards that meeting. Number one, this letter urges the Fed to not contemplate further rate hikes. So going into October 31st, November 1st, no more rate hikes. Let this be the end of rate hikes. And then number 2, the Fed will not sell off any of its MBS holdings until and unless the housing finance market has stabilized and mortgage to treasury spreads have normalized. We have no sign of the mortgage to treasury spread normalizing anytime soon. That's what's keeping this at near 8% as opposed to just under 7%. It's the spread normalizing is one of the reasons Mortgage Banker Association believed we'd be at 6% to end the year on the 30-year fix instead of where we're going to be, which will certainly be up over 7% with the path that we're on now, maybe even up over 8%. They thought that spread would normalize. So when the Fed says don't sell off any of, or when this letter to the Fed says don't sell off any of the Fed's MBS holdings, when the Fed starts selling mortgage-backed securities, you'll see capital tighten up even more than it already has. Capital is really tight right now for mortgage borrowers. So when this letter from, again, NAHB, if you're just joining, National Association of Home Builders, National Association of Realtors, as well as Mortgage Banker Association, this letter from those three trade associations dated October 9th, yesterday, Monday, directly to Jerome Powell and the Fed, when they say, hey, no further rate hikes, but when they also say do not sell off any MBS holdings, what they're saying is, okay, we're at a 27-year low on mortgage demand. People can't afford the house. This is likely going to put us into a recession in 2024. They said that in this letter. But they're also saying don't shrink capital, accessible capital in the mortgage industry right now by selling off MBS holdings. These steps will provide the market greater certainty about the Fed's rate path and its plan for the MBS portfolio, reduce volatility for traders and investors. Housing activity accounts for, this is something we've talked about here, and I actually have a higher number, 17, but we'll go with their number here. For real estate professionals to keep in mind what purpose you serve for this country and for this economy. Housing activity accounts for nearly 16% of GDP. That's according to a National Association of Home Builders estimates. I've seen it as high as 17%, but you get the picture. Housing activity is a big chunk of the GDP here in America. We urge the Fed to take these simple steps to ensure that this sector does not precipitate the hard landing the Fed has tried so hard to avoid. Of course, they do want to see a soft landing. They've already broken the back of housing, and this is the white flag that NAHB, MBA, and National Association of Realtors, they had their three logos at the top of this letterhead that they sent to Jerome Powell yesterday. This is the white flag that they're waving. Okay, you've broke housing. Transactions have plummeted. You did that through the rapid increase of the rates. Now it's time to stop. Unfortunately, the only other tool Jerome Powell has at his disposal, other than the rates, is to continue this restrictive policy until they break the labor market. And so if they continue down this path of trying to fight inflation down to 2%, and they don't get there, that's their last ditch effort. Let's go ahead and break the labor market. And the labor market, of course, has been very, very, strong against that, projection or outlook here in the future. All right. So looking forward, according to Fannie Mae, looking backwards and looking forward, according to Fannie Mae. Fannie Mae just had their home purchase sentiment index released yesterday, and their HPSI decreased 2.4 points in September to 64.5. This is obviously as these elevated rates further dampened already pessimistic consumer housing sentiment. These feelings that I was talking about yesterday, consumer feelings, their sentiment about the market continue to go into the wrong direction. And when we see that, you see credit cards increase, you see savings deplete. Both of those signals push us closer into a potential recession. Their feelings are just as important as everything else that's going on, because their reaction to their feelings, the actions that they take, consumers, over the next couple months based on these feelings, have an impact on the economy. All right. So here's the attitudes toward home buying and home selling conditions, and they differ significantly. We'll put, obviously, the chart into your daily download for BAMX members. You can use code HOT to get 10% off of BAMX. Get access to the after party today after the business planning event at 3. The business plan event is open to everybody. It's down below. Consumer attitudes toward home buying and home selling conditions differ significantly. Net good time to buy percentage, dark blue, is down below uh, in the negatives there, down below that 0% threshold in the negative 60 plus range, while you see good time to sell up in the 60 plus range. So complete opposite there on whether now is a net good time to sell versus a net good time to buy on how consumers feel about the housing market. These feelings are going to continue into quarter four, if not elevate into quarter four in quarter one. This is why real estate professionals need to go wide, need to talk to more people, need to figure out how they can help more people in this market. When you're thinking long term and not cherry picking, you're going to be amazed on what your business looks like in 12 to 24 months. And in 12 to 24 months, a lot of things are going to be different. NAR might not even be on the top of those letterheads sending to Jerome Powell in 12 to 24 months. A lot of things are going to be different in this market. So when you build these long-term relationships, as people in the housing community, the really good ones, are doing right now, going to be in a real great position to capitalize in 12 to 24 months. Consumers are also not seeing much affordability relief in sight. They continue to expect home prices to increase in the next 12 months. So consumers don't believe overall that home prices are going to drop in the next 12 months. They believe they're only going to go up, which is going to create less affordability for them. They also indicated that the personal economic situations are showing signs of strain, including lower year-over-year household incomes and a reduced sense of job security. In our view, all of this points to home purchase affordability remaining a problem for the foreseeable future, which we forecast will keep home sales sluggish into next year. This is Fannie Mae. This is how your consumers here, real estate professionals, feel about the market per Fannie Mae as of October 9th. This is how the 10-year Treasury feels about the market and feels about just the global situation that we're faced with right now. It's actually down. So you saw, with the news that happened over the weekend, you did see a bunch of investors go into bonds. So you had a whole bunch of flight to safety for investors. And as they bought up those bonds, the Treasury yield will go in the opposite direction. We've seen that now. And so it's actually created a little bit of a swing down on the 10-year to 4.697 on the 10-year Treasury, still well above the 4.5 long-term average that we've seen since 1790. It's still going to keep the 30-year fixed pretty elevated. But when we get a new read today in the 30-year fixed, it should be much lower than where they ended on Friday. By the way, we didn't get a 30-year fixed daily survey from Mortgage News Daily yesterday. I guess it was because of the holiday. The markets weren't closed yesterday, but I guess the mortgage rate was down yesterday for the holiday that happened yesterday. So we ended the week at 7.81 on MND's 30-year fixed daily survey. I do anticipate with the 10-year down slightly that this should come down a little bit, at least under 7.75 here today, as we will look for that later this afternoon on this Tuesday. All right. If you are interested in the business planning, it's tomorrow. It is not today. You're right. All right. It is tomorrow. So thank you, Haley. So I've been saying it's today. It is tomorrow. It is on Wednesday. Today is a Tuesday for sure. So yes, it is on Wednesday at 3 p.m. Eastern. We have the link below that's open to absolutely anybody. And then if you want to get into the after party tomorrow, after the live webinar that we're hosting at 3:00, myself and Tom Toole, on business planning, on how to apply a lot of this stuff into your business plan for 2024. That'll be live at 3. You can sign up for that link below. But if you want to be in on the after party, you got to be a BAMX member. Use code HOT to get 10% off of BAMX. Hope you enjoyed this hot sheet. Love for you to consider subscribing to the channel if you're getting value, and share this with a real estate professional who can benefit from it. We'll see you back here tomorrow on the hot sheet. And tomorrow, we've got the live webinar. Have a great, productive Tuesday. Until I see you tomorrow morning, Toodaloo.